Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm back with another weekly edition of the Economic Review, this time for the week ending September 23rd, 2022. So fall is upon us and the markets are still volatile. Looking at the returns this week as of the close on the Thursday, negative for equities. It's even more negative this morning prior to market open on Friday. Interest rates are rising this morning. So after a positive first 4 days for bonds, we could be slipping into negative territory here also before the week is said and done. Interestingly, the US dollar remains very strong as a safe haven. The euro is weak, the yen is weak, so that means that the USD is getting stronger versus the CAD, so the Canadian dollar continues to fade. So even though the TSX outperform the S&P 500 in local currency, when you bring everything back into Canadian dollars, the TSX underperformed a little bit the S&P 500. So, but both negative, and we are getting very close now to the June lows for the S&P 500. We're within about 1% as of pre-market trading on Friday. So we're the near the being near the lows. That means that we're near the median bear market drawdown. So the median bear market historically has been minus 25%. The average bear market is minus 30%. So we're getting near the median level. So that doesn't mean that we're about to find a bottom necessarily. It just means that we're just getting in a zone where if you invest now, looking forward 1 year, 3 year, 5 years, starting to see an interesting level. So we are not changing our strategy yet. We're not turning bullish yet, but we're reevaluating the risk reward of being underweight equities structurally, like we've been for most of this year. Might be making some changes as and if we continue to move lower and within the zone where bear markets, you're starting to see historical comparisons that are more convincing. So we'll let you know when we change our views. Not yet, but we are reevaluating the necessity to be as underweight equities as we've been since the beginning of the year. So again, it's all going to be about the signals that we get from the markets, and we'll keep you posted as our views evolve. This is not a 1 week thing. This is, a process. So this week it was again about inflation and about central banks. So always the same story, but it's a very powerful story here in 2022. The Fed hiked another jumbo hike, 75 basis points. The language that was used by the Fed was again very hawkish. They're very committed to fighting inflation to the end. They published some of their forecasts. They're looking at the economy. They're seeing weaker prospects ahead as interest rates rise, the economy slows, inflation slows too. So this is the arc that they're looking for. But now the markets are starting to react very strongly. At the few months ago, markets were not convinced that the Fed would hike all the way to 4% by the end of the year. Now markets are starting to think that they will go beyond that, and they're starting to understand the message that rates will remain high for a while. So this is creating an adjustment period, and this is what's behind all of the volatility that we're seeing now in markets. So the result, if you look at interest rates and the yield curve, that now that the 2-year rate is at a 15-year high. So the last time the 2-year rate was as high as now, it was in 2007, pre-financial crisis. So it's been a while. That means that the message from the Fed is getting heard, understood by the markets. So there's a good it's a good development there, because that means that monetary policy is starting to work. When you look at the yield curve, there is always a lot said about the 10-year, 2-year differential. So when the 10-year rate is below the 2-year rate, many observers are talking about an inversion of the yield curve that could mean that there's a recession coming. We prefer to look at the 10-year rate minus the 3-month rate. This is a much stronger signal through time, so less false positives. So let's calling recessions and no recession happens. And when this part of the curve inverts, typically a recession doesn't it's not far behind. And now good news is that it is not pricing in a recession yet. And even the spread widened recently, so the 10-year rate is rising quicker than the 3-month rate. So the bond market now is not sending big flashing signs of an impending recession. So good news there if there's any. So in Canada, we had the CPI this week, lower than expected on a year-over-year basis, month-over-month basis. So we're seeing some good progress here. That monetary policy is starting to work into taming inflation. The fight is not over yet. Of course, the levels that we're at now, they're still very uncomfortable for the Bank of Canada, but it's good. It's good progress. And interestingly, inflation in food continues to climb. So another very important indicator that the Bank of Canada, they cannot stop the fight here, but services, housing prices, they're cooling, and this is a very welcome sign here. So before the end of the year, we still expect the Bank of Canada to continue to hike, the Federal Reserve to continue to hike. Rates will be higher, somewhere around 4% at the end of the year. We'll see how things evolve in financial conditions, how things evolve in housing, but expect some more hikes. But it's going to be very important to start to listen to the message much more closely. Are they committed to hiking until inflation is back to target, or they're starting to see conditions for slowing rate hikes, especially in Canada? So this is what we'll be focusing on over the next decisions. So what to watch next week? GDP growth in Canada for the month of July, and in the US, we'll have consumer confidence from both the Conference Board and the University of Michigan. So very important indices, along with personal income and personal spending data. So another eventful week ahead of us. So that wraps it up for the week. ia.ca/economies, or go-to webpage, are in your interest podcast. If you haven't listened to it, we're starting to see some very strong numbers now. We're cracked the top 20 in Canada for the investing category of podcasts. So very proud of that. And thank you very much if you're a listener of our podcast for the support. There are more episodes in the pipeline, and this is a thing that's a long-term thing. So if you want to hop aboard, the train has left the station and it will continue for a good while. Economy and Finance 101, there's always some material coming, and you can follow me on Twitter and on LinkedIn to have access to all of the thoughts that I share on social media. So thank you very much. It's always a pleasure to serve you on a weekly basis, and I'll see you again next week.